Tax reform has happened. Passed by the House and Senate, the Congress, signed by the President. We should be noticing, starting this month, differences in our paychecks. All depends on where you live. And over the next several months, more changes could start adding up. So how are we going to benefit from this, and how can we see to it that we are going to benefit from this? And joining us once again, local financial professional Larry Kallevig from Haven Financial Group. And Larry, welcome back to the show.
Good evening, Al.
So, what in Minnesota? What are people seeing? How much more in their checks? When you break it down, have you analyzed that?
Well, it'll be different for everybody. The main thing is to make sure that you know what you're withholding. But for many people, they're going to see their paychecks grow because of less withholding. So that's the good news, especially with about $100 billion in tax cuts for individuals. So we've consistently seen about 9 out of 10 households that are going to save, and I think the average is $2,000 per household savings this year. Average, of course, that'd not be every household, but
right.
They're going to start saving their money.
So how can we benefit from this? Now, I understand you have 5 smart ideas that it moves in our how we handle our money that we can make. Let's start with the first one. What can we do, Larry?
Well, number one, you're going to be getting a little bit more money. So what a better time than to start saving a little bit more. This isn't money you've had before, so what a great time to start increasing the 1% to 2% extra to that 401k or perhaps the IRA. You haven't had this money before, so great time.
Yeah. What else? What's the second one?
Well, like I mentioned, the withholdings. This is an interesting one because, there's going to be changes in that, and I do have some tables on my website you can go to, and they're going to come out with some new calculators at the end of the month, the IRS is. But lots of people have more than enough withheld, and they get a big refund. And some people think that's just great. Others, they don't withhold enough, and then a lack of discipline can cause problems. But ideally, do you really want to give a short-term interest-free loan to the government? Ideally, like to break even. In fact, most see that. So don't withhold too much. Just try to get it just right. So it's kind of a break even.
Sure. One thing that when we've seen, and it's very important to point out that these weren't tax cuts. These were reductions in tax rates. And we've seen before when JFK reduced the tax rates, I think it was the first thing he did as president when he was elected in 1960. And Ronald Reagan did it as well. Both times we saw revenue dramatically increase flowing into the government. And that's because, doggone it, we're Americans and we love to spend our money. It burns a hole in our pocket. And that's not a bad thing. When we buy more products, that creates more jobs. And when there's more jobs, more people are paying taxes and more revenue is flowing into the government. And that is the way it works. But I think you're right. I think we want to keep as much of that as possible. And the idea of increasing what you're putting into your 401k, I think is just a great idea. What other recommendations do you have?
Well, I'll piggyback that because, again, most people are going to spend it. So increasing that retirement savings, that is good. And then what a better time. I mean, if things from this tax overhaul really increase, like this being economic conditions, what a better time. It's going to be a hot job market. What a great time to ask for a raise, right?
Yeah. And you want to know something? Each and every one of us feels whether we're worth going in and asking for that raise. We know whether we've been doing a good job or not, don't we?
Right. In fact, why be complacent? If you don't ask, you're not going to get an answer. And with unemployment, who knows? It could get as low as they're saying, maybe 3.5. Well, research what others are getting paid. With confidence in research, go ask for a raise and begin the negotiations and have the facts to back it up, and you might be pleasantly surprised.
Yeah. What else? What else is on your list of things that we need to do?
Well, the interest rate environment, that's a big one that's created all kinds of shambles here in the market the last few days, and we can go there and not go there. But with interest rates, I'll point out a couple things. If increasing the rates, they didn't last week, but there's talks that Fed might increase it 2-3 times this year. Mortgage, if you're looking to buy a home, certainly that might be something you might want to speed up as rates potentially could go over 5%, historically low, and that high credit card debt. As rates go up, those are the things that you're going to see some changes in probably first.
You know, when I hear you say going up to 5%, I smile, I chuckle. I remember back in the, what was it, probably 82. I think we were at about 14% on a mortgage, which was, I mean, think about that. Unbelievable. You know, those who were living on a fixed income, retirees, you know, the money they were getting was interest rate was high also, and they loved it. Those youngsters like us that were buying homes, boy, that was tough.
Right. We see the home buying and the mortgages, the high interest rates. Of course, what the retirees were seeing is the returns on their CDs back 14, 15%. Of course, those rates today, we know on those savings are so low. But those certainly are the things to be looking for as we see rates. The other one is inflation. That's getting a lot of talk right now. We haven't seen inflation, but if anybody remembers back to the Carter era, inflation's real. Just hasn't been recently.
Let me ask you this, Larry. Why are the interest rates going up? Is it because the market is doing so well that they feel confident that the market can handle it? What is the reason that interest rates are climbing, and why has the stock market crashed?
Well,
not crashed. We've seen a correction, not a crash. I don't want to say crash. We've seen a correction, a mild correction.
Correct. Well put. Although with the phones ringing the way they were and how people get a little worried, you think it crashed, but you're right. A correction, call it what it is. The rates have been historically low. I mean, everybody knows the rates are so low, so there's only one direction they really could go. But the concern is they rise it could slow down the economy because of borrowing, the cost of. But eventually rates, there has to be more of a balance, and there hasn't been, but it raises major concerns, which so goes the roller coaster the last 3 days.
You know, I've heard people say, well, what is wrong with having a robust market, a bull market like we're seeing? Why does the Fed have to mess with it? Why do they have to raise interest rates? You know, get your hands out of it. Let the market handle it. What's your response to that?
Well, everything in balance. The pendulum has to swing both ways. Getting some on the flip side, many would like to get some returns on some of those lower risk investments, if you will, the CDs, money markets that have paid nothing. There has to be a balance on both ends, and quite frankly, the rates have been just bottom low for a long period of time.
Yeah. I remember when my parents built their home in Richfield in 1953. Their interest rate was like 4 or 4.5%, right in that area. And the home that we have right now, I think our interest rate is like 3.85 or something like that percent. You know, so going from 1953 into the 21st century, that's mind-boggling when you look at those low interest rates.
No, it most definitely is. And a lot of people, especially younger, they don't know any different. Those that have been around a long time like us, we know different because we've seen it. But nothing lasts forever. Yeah, just like the market going up, a bull market for 9 years. Yeah, we don't like it. It creates concern and some panic and fear, but because we haven't seen it for so long, so we forget.
So what caused the correction that we saw on Friday and then yesterday? What happened?
Well, investors are nervous. They're nervous about the bond prices going up, which are directly tied to those interest rates. It's just true that might slow down the economy. Things get robust too fast, and they come to a screeching halt, and where do we go from there? So certainly we don't have a crystal ball. We don't know where it's going to go, which is why we have daily conversations with our clients, say, be balanced, stress test your portfolio. Surprises are not fun at any age, but know what the expectations are going to be on the good and the bad so you can minimize those surprises.
Well, it's interesting having you on, Larry, talking about this because everybody is talking about it, especially when we had the huge drop yesterday. Is there any reason to be concerned about this? You know, I didn't call my financial advisor. I didn't even look to see the stuff that I have, what was going on with it, because I'm in it for the long term and I'm not worried about it. Am I nuts?
You know what? You just described your situation, which is very, very accurate. And everybody's situation is different. What age are you? What is the need for the money? Do you have to have the money? Are you going to be forced to take it out for income? Or are you at the age of required minimum distributions where you have to take it? So all of that is, are factors. But putting all of that into the equation, the rule of 100, and how much risk should you have? Well, 100 minus your age equals how much risk? Well, rule of thumb, but it can vary. Problem is most people have no idea where they're at other than the fact they've made money for the last 9 years. In the meantime, they forgot they also got 9 years older.
Yeah. There's times when you sell, other times you just sit back and don't panic. And with all of the sell-offs that occurred on Friday, is that nothing more than people panicking, Larry?
Much of it is the panic, the emotions. The greed got them to where they're at. This isn't surprising. I mean, there's concern that is this bull run at the tail end? Well, you could say, it's all cyclical. But a lot of this is buying and selling. I've even heard interesting saying that this was, all premeditated by political reasons and all that stuff. But emotions are never a good recipe for investments. But surprises come from for many people not understanding what they're doing, or just kind of being disconnected because what they've seen for the last so many years.
Or is it guys like me that don't panic? Is that we don't understand what's going on?
Well,
it's either or, isn't it? Yeah.
It could be either or, but it's needs based because lots of people they need the money, and they're required to supplement income with it. Others, if you don't need it and don't have to sell, then don't worry. Keep the emotions. Don't panic because emotions and investments typically don't bode well. There are indicators that are out there, interest rates, inflation, and for those that like to research, profit earnings ratio that do cause concern. But overall, just have expectations and know what to expect.
Here's the last question, Larry. We see a lot of financial professionals, such as yourself, that come out and make predictions all the time. What makes their crystal balls any better than anybody else's?
Great question, Al. Sometimes people hear what they want to hear, and some people pick up on the fact, they have high returns and this, that, which is all great. Returns, there's that's great. But if something sounds too good to be true, it very well could be too good to be true because I don't have a crystal ball. We love to see the markets do well, a 9-year run, and I hope it continues 9 more years. History would say probably not. But have a game plan, consult a professional, and make sure you validate what he or she is saying.
Larry, do you have a website there at Haven Financial that we can check out?
HavenFinancialGroup.com, Al.
Very good. Larry, again, thank you for joining us once again. We do appreciate it.
Thank you.